Ladies and gentlemen, habari zenu. Hope you are doing well. My name is Dr. Robert Mugo. I am an academician, a financial analyst, and a CPA. By now, I know you have been going through my lessons and have been focusing on borrowing. Today, I want us to talk about borrowing from banks. You can see I have some label here just representing banking institutions, not necessarily this one. But what are the advantages of taking loans from banks? The first advantage, you find that banks have big muscles. Banks can be able to give you huge amount of loans. Banks can give you as much as you need, as much as your business qualifies, as much as your payslip qualifies. So this is something that other financial institutions may not be able to do. The next advantage of borrowing, or why you should take loan from banks, is the duration. You know, banks give loans up to 20 years, up to 25 years. Somebody who has just been employed and in 30 years can take a mortgage and they will repay until 55 years, until 58 years. So this is something that other institutions may not be able to do. So should you want something like mortgage loans that are of very long-term nature, you may not get that from or you may not get that from other financial institutions. So it is loans that are long-term, very, very long-term, you'll get it from banks. Another reason why people may prefer taking loans from banks, sometimes the model that they use in computing your interest gives them an advantage, or gives the customer an advantage. We call this amortization way of computing interest. You take a loan from bank A, you pay, if it is a loan for 48 months, you pay the same amount from month 1, month 2, month 15, all the way to month 48. For a business person, that will enable you to plan. Every time I know I will be paying this amount of money. Now, still on that model, you find that the bank will give somebody, if you are to use, let's say, a reducing balance model, and you compare to this amortization model. For amortization, you qualify slightly higher amount of loan as compared to a reducing balance model, where you pay the first installment on reducing balance is the highest. It goes reducing. The last installment, you just pay the principal and very small amount of interest. Another advantage that you may have in terms of borrowing from banks, banks do not require you to have deposits to borrow. Other financial institutions, they will tell you, you want to borrow $1 million, the multiplier is 4 times. Maybe you need deposit of 250,000. So I can approach Bank Y with 0 deposit and they will lend me money. And some proponents argue that if you take a loan from the bank, the entire amount is a loan. Other institutions, they will say part of the amount that you're being charged interest is also your asset. So your loan is actually less. If the multiplier is 4 times, maybe you need 250,000 to take a loan of $1 million. The actual loan is 750,000. Banks, because of being big institutions, are quite stable. You know, they are regulated by the Kenya Banking Act. There are some that are listed in the Nairobi Securities Exchange are regulated by the Capital Markets Act. All banks are regulated by the Central Banking Act. So basing on that, you have gone through my previous slides about borrowing from this, advantage of this and this. You now can make your decision. Allow me to stop at that. You can go to my YouTube channel, Dr. Robert Mugo. You can go to Instagram. You can go to Facebook. You can have here TikTok. You can even go to X. Enjoy your weekend.